Did you know the average investor significantly underperforms the market? Studies show a typical 20-year return for an S&P 500 index fund beats the average investor's portfolio by over 2% annually. That's a staggering cost. Over 30 years, that 2% difference can mean hundreds of thousands of dollars lost. For a $100,000 initial investment, it's the difference between $1 million and just $550,000. Why does this happen? The common wisdom buy low, sell high. It sounds intuitively brilliant, right? But ironically, this very instinct is often the most destructive force to your long-term wealth. Let's explore why. Our brains are wired for immediate threats and rewards. When the market drops 10%, panic sets in. When it soars, FOMO takes over. These primal reactions hijack rational decision-making, leading to poor timing. Consider the market's nature; it thrives on uncertainty. The biggest gains often follow the biggest drops. Yet, our gut tells us to run for cover when things look bleak. This is where intuition betrays us. Historical data consistently shows that missing even a few of the market's best-performing days can drastically reduce long-term returns. These days are almost impossible to predict, occurring randomly. For example, between 2000 and 2020, if you missed just the 10 best days of the S&P 500, your average annual return would drop from 6.1% to 2.4%. That's nearly two-thirds of your potential gains gone. This means trying to buy low by selling during a dip risks you missing the subsequent rebound. And trying to sell high often means missing further upside as the market continues its climb. The market timing premium is actually a negative number. It's the cost of trying to outsmart the market. Investors attempting to time typically lose, not gain, compared to a passive approach. So, if buy low, sell high is the goal, when exactly is low? Is it a 5% dip? A 20% bear market? And how do you know it won't go even lower? The market doesn't send clear signals. Often, low feels like pure despair. When the news is dire and everyone is selling, that's usually the bottom. High feels like euphoria when everyone is piling in. These are emotional extremes. Take the dot-com bubble. Many bought at the peak in 1999-2000, driven by excitement, then sold in panic after the crash. They bought high and sold low, exactly opposite of the ideal. The same pattern repeated during the 2008 financial crisis. Investors pulled out when the market was at its lowest, locking in losses, and missed the subsequent recovery. This is the timing trap. These examples aren't outliers, they're the norm for active timers. The emotional toll of watching your portfolio fluctuate often overrides any logical, data-driven approach. It's a mental battle. So, how can we truly understand the impact of these intuitive, yet flawed, timing decisions? We've developed a simple simulation model to illustrate the difference between passive and active investing. Imagine two investors, both starting with $10,000 in January 2000. They invest in the S&P 500. Their only difference? Their approach to market timing over a 20-year period. Investor A is the sloth investor, passive, disciplined, and consistent. They simply buy and hold the S&P 500 index fund, ignoring all market noise for 2 decades. Investor B is the active timer. This investor tries to follow the buy low, sell high mantra, reacting to market movements based on common, intuitive signals. They believe they can beat the market. Their rule for timing: if the market drops by 10% from its recent peak, they sell everything. If it recovers 10% from its recent trough, they buy back in fully. Simple, right? This 10% threshold is a common psychological trigger for many investors. It feels like a significant move demanding action. But does acting on it truly lead to better outcomes? Let's fast forward 20 years, from January 2000 to January 2020. This period includes the dot-com bust, the 2008 financial crisis, and several strong bull markets. A true test of strategy. First, Investor A, the sloth investor. They simply held their $10,000 investment. Through all the ups and downs, they did nothing. What was their final portfolio value? By January 2020, Investor A's $10,000 had grown to approximately $32,600. A solid 226% return, simply by staying invested. No stress, no constant monitoring, just patience. Now, Investor B, the active timer. Remember their 10% sell/buy rule? Over those 20 years, they made 21 trades, selling out 11 times and buying back in 10 times. A lot of activity. After all that effort, all that stress, Investor B's $10,000 had only grown to $14,000, a mere 40% return. That's a huge difference from $32,600. The cost of timing is undeniable. The timing tax for Investor B was over $18,000, not even accounting for transaction fees or capital gains taxes. Their intuition-driven strategy cost them significantly. This simulation clearly demonstrates that acting on common intuitive signals like a 10% drop often leads to worse outcomes. Our primal urges to do something are powerful but detrimental. The key takeaway: discipline and patience often outperform frantic activity. Instead of trying to outsmart the market, focus on consistency, diversification, and a long-term perspective. This isn't to say market analysis is useless, but rather that emotional timing decisions are detrimental. True investment success often comes from doing less, not more. In Chapter 2, we'll dive deeper into specific cognitive biases that sabotage investor returns and how to build a robust investment framework to counter them. Stay chill, stay invested. In Chapter 1, we uncovered the pitfalls of intuition in investing. Today, we're diving into Bob's paradox: how even imperfect timing can lead to superior long-term results. Many investors obsess over timing the market, trying to buy low and sell high. But what if your timing is consistently, suboptimal? Meet Bob. Bob has an uncanny knack for investing his lump sum right before a major market downturn. He's the poster child for bad timing. Let's consider Bob's investment journey. In October 2007, just before the great financial crisis, Bob invested $10,000 into the S&P 500. The market subsequently plummeted over 50% by March 2009. Most investors would have panicked and sold, locking in massive losses. But Bob, in his sloth-like wisdom, simply held on. No panic selling, no desperate attempts to time a recovery. Just patience. Fast forward to the end of 2023. That same $10,000 Bob invested at the 2007 peak would have grown to approximately $35,000. That's a 250% return over 16 years, despite buying at the absolute worst possible moment right before one of history's biggest crashes. Now let's imagine Alice, the perfect timer. She somehow invested her $10,000 at the very bottom of the market in March 2009. By the end of 2023, Alice's perfectly timed $10,000 would have swelled to roughly $70,000. A phenomenal 600% return. Clearly, Alice's timing was superior, but compare Bob's $35,000 to Alice's $70,000. Bob still made significant gains. Now, consider Charlie. Charlie, paralyzed by fear of market crashes, kept his $10,000 in cash, earning negligible interest. Charlie's $10,000 would still be $10,000, maybe slightly more due to inflation, but with significantly diminished purchasing power. Here's the paradox: Bob, the worst timer, still ended up with over triple Charlie's wealth. Time in the market truly beats timing the market. This isn't just about Bob. Historical data consistently shows that missing even a few of the market's best days can severely impact returns. For instance, missing just the 10 best days in the S&P 500 between 2003 and 2023 would have slashed your returns by over 50%. These best days often occur around periods of high volatility, making them incredibly difficult, if not impossible, to predict. The market's long-term trend is upward. Despite crashes and corrections, staying invested allows you to capture this fundamental growth. This is the power of compounding. Your initial investment, even if poorly timed, grows on itself over decades, overcoming initial setbacks. Consider the S&P 500's average annual return of roughly 10% over the last century. This includes all market crashes and recoveries. The key is to ride out the inevitable ups and downs. Market volatility is not a bug, it's a feature of long-term growth. So, what's the actionable takeaway from Bob's paradox? Focus on consistency and duration, not precise entry points. Implement a dollar-cost averaging strategy. Investing a fixed amount regularly, regardless of market fluctuations, smooths out your entry price. Avoid the temptation to pull your money out during downturns. These are often the worst times to sell and the best times to accumulate. Embrace a long-term mindset. Think in decades, not months or quarters. This allows compounding to work its magic. Even if your initial timing is flawed, consistent investment over a long period will likely outperform those who remain on the sidelines. The true alpha in investing often comes from disciplined inaction during turbulent times, not from heroic market calls. Bob's paradox teaches us that patience and consistent participation are your most powerful allies in building long-term wealth. Don't strive for perfection, strive for presence. Stay invested, stay calm, and let time do the heavy lifting. Join us in Chapter 3 as we explore how to build a resilient portfolio that thrives through all market conditions, echoing Bob's enduring success. Welcome back. In this chapter, we tackle the seemingly impossible challenge of market timing. Many investors believe they can predict market swings, but quantitative studies reveal a harsh truth about this high-risk strategy. The core issue isn't just predicting a general trend, but pinpointing the absolute best trading days. Miss just a handful of these, and your long-term returns can be drastically, irrevocably altered. A J.P. Morgan study on S&P 500 data from 2003-2022 showed remarkable findings. Staying fully invested yielded a 10.37% annualized return. But what if you missed the best days? Missing just the 10 best days of those 2 decades returns to 5.61%. Miss the 20 best days, and your return plummeted to a mere 2.6%. The top 30 days? You'd be down 73%! These best days often occur just after the worst days, making them incredibly hard to predict. Panic selling or waiting for the bottom means you're almost guaranteed to miss the rebound. The cost of being out of the market, even for a short period, can be staggering. You're not just losing potential gains, you're actively diminishing your long-term wealth accumulation. Consider a hypothetical $10,000 investment over 20 years in the S&P 500. Staying fully invested, it could grow to over $70,000. Missing just those 10 best days? It's barely $29,000. The inverse is equally true and difficult avoiding the worst days. Trying to dodge every downturn often leads to sitting out the recovery, costing you more than you saved. Beyond financial returns, market timing exacts a heavy psychological toll. The constant stress of monitoring, predicting, and reacting can lead to chronic anxiety and burnout. Decision fatigue sets in quickly. Every market fluctuation becomes a test of your judgment, leading to impulsive, often detrimental choices driven by fear or greed, not data. Behavioral finance research highlights this. Regret aversion causes investors to cut losses quickly and chase gains, often selling low and buying high. The exact opposite of sound investing. The media often exacerbates this, with sensational headlines and expert predictions fueling the timing illusion. It creates a narrative of urgency that rarely aligns with prudent, long-term wealth building. Quantifying the odds of consistently timing the market successfully is virtually zero for individual investors. It's akin to winning the lottery repeatedly, year after year. Academic studies consistently back this up. Firms like Dalbar and Vanguard have produced extensive research showing that the average investor significantly underperforms the market. Dalbar's quantitative analysis of investor behavior CABE report is a prime example. It consistently shows that investor returns often lag behind market indices due to poor timing decisions. The primary culprit isn't a lack of intelligence or research, but emotional responses to market volatility. Fear and greed drive irrational decisions, leading to buying high and selling low. This leads to a predictable psychological cycle: excitement during bull markets, fear during corrections, panic during crashes, and regret when the market rebounds. It's exhausting and unprofitable. Frequent trading also incurs significant transaction costs and taxes. These expenses further erode any potential gains, making consistent timing even more improbable. Even professional fund managers, with vast resources and sophisticated tools, rarely outperform the market consistently through timing. Their focus is often on strategic asset allocation. The illusion of control is powerful. We want to believe we can outsmart the market, but the data clearly shows that active timing strategies for individuals are a losing game. Think about the opportunity cost. The time and energy spent obsessing over market timing could be better invested in career growth, family, or simply enjoying life. Your financial peace is valuable. The data is unambiguous, consistent, long-term market participation, regardless of entry point, overwhelmingly beats any attempt at timing. Simplicity and patience are your best allies. In our final chapter, we'll explore practical strategies for building enduring wealth, strategies that embrace market efficiency and minimize emotional pitfalls. Stay chill, stay invested. Welcome to our final chapter. We've journeyed from understanding cognitive biases and the true power of time to realizing the futility of market timing. Now, it's time to build your immutable portfolio for enduring wealth. An immutable portfolio isn't about chasing hot stocks. It's about a resilient, diversified strategy that withstands market storms, allowing you to maximize time in the market and minimize emotional errors. The core principle is radical diversification. Don't just own stocks. Consider a global mix of equities, bonds, real estate, and even commodities. This spreads risk, ensuring no single asset tanks your entire wealth. For instance, a classic 60-40th portfolio, 60% stocks, 40% bonds has historically offered an average annual return of 8–10% over decades, with significantly less volatility than a 100% stock portfolio. Beyond traditional assets, consider diversifying with rate for real estate exposure or gold as a hedge against inflation and market uncertainty. These can smooth out returns during turbulent times. Next, automate everything. Set up recurring transfers to your investment accounts. This dollar-cost averaging strategy forces discipline, removing emotional decisions and ensuring consistent investment regardless of market sentiment. Dollar-cost averaging means investing a fixed amount regularly. For example, $500 every 2 weeks. This strategy has historically outperformed attempts to time the market over long periods by buying more shares when prices are low. Rebalancing is crucial. Annually, check your portfolio. If stocks soared, you might be 70/30th. Sell some stocks, buy more bonds, returning to your target 60/40th. This forces you to buy low, sell high systematically. This disciplined rebalancing prevents your portfolio from drifting into overly risky territory and locks in gains from outperforming assets, directing capital to underperforming ones when they're cheaper. Minimize fees. Even a 1% annual fee can erode over 25% of your total returns over 30 years. Opt for low-cost index funds or ETFs from providers like Vanguard or Fidelity, which often have expense ratios below 0.10%. Understand tax efficiency. Maximize tax-advantaged accounts like 401(k)s and Roth IRAs. These offer significant tax benefits that compound over time, dramatically boosting your net returns. Behavioral discipline is your greatest asset. Pre-commit to your investment plan. Write it down. Share it with a trusted friend or advisor. This creates accountability, making it harder to deviate during market turmoil. Ignore the noise. Financial news is designed to create urgency and emotion. Remember, short-term market fluctuations are irrelevant to your long-term wealth goals. Stay calm, stay invested. Understand your own biases. Are you prone to FOMO, fear of missing out, or panic selling? Acknowledging these tendencies is the first step to overriding them with rational, systematic investing. Now, let's talk capital deployment. Before investing a single dollar, ensure you have a robust emergency fund, 3–6 months of living expenses, safely stashed in a high-yield savings account. This emergency fund is your financial shield. It prevents you from being forced to sell investments during market downturns to cover unexpected expenses, preserving your long-term growth potential. Next, tackle high-interest debt. Credit card debt at 18–24% APRA is an immediate drag on your wealth. Pay it off before investing. The guaranteed return from eliminating this debt far exceeds potential market gains. Once emergency funds are secure and high-interest debt is gone, then deploy your capital. For a large lump sum, studies often show investing it all at once historically outperforms dollar-cost averaging. However, for psychological comfort, especially in volatile markets, a gradual deployment over 3–6 months via DCA can reduce anxiety. This trade-off between potential return and peace of mind is personal. Consider trigger-based deployment for cash on the sidelines. If the market drops X%, e.g. 10%, deploy Y% of your reserved cash. This provides a systematic way to buy dips without emotional timing. Remember, the goal isn't to get rich quick, but to get rich slowly and surely. This sloth approach focuses on consistency, patience, and avoiding common pitfalls that derail most investors. Here's your action plan. First, define clear financial goals. Are you saving for retirement in 30 years? A down payment in 5? Clarity drives your asset allocation decisions. Second, assess your true risk tolerance. Not what you think it is, but what you can actually stomach during a 30% market crash. Be honest. This dictates your portfolio's bond allocation. Third, choose a diversified asset allocation model. A simple 70/30th or 80/20th global stock/bond split is a great start. Then, set up automated contributions to low-cost index funds or ETFs reflecting this allocation. Fourth, schedule annual portfolio reviews and rebalancing. Mark it on your calendar. This disciplined checkup ensures your portfolio stays aligned with your goals and risk tolerance without emotional interference. For resources, explore reputable platforms like Vanguard, Fidelity, or Schwab for low-cost index funds. Consider books by John Bogle or Burton Malkiel for deeper insights into passive investing. Remember Bob from Chapter 2? His consistent investment, despite imperfect timing, generated significant wealth. Your immutable portfolio, combined with behavioral discipline, makes you the next Bob. The greatest opportunity cost isn't missing the best days. It's the cost of inaction. Don't let paralysis by analysis or fear keep you from starting your journey to financial freedom. Your journey to lasting wealth begins now. Embrace the sloth mindset, patient, persistent, and unbothered by short-term noise. Start small, but start consistently. Time is your most powerful ally. The greatest risk is not the market, but your own behavior. Stay disciplined, stay invested, and let the magic of compounding work for you. Build your immutable portfolio. Build your future.